So, you've probably seen the headlines about MetLife's latest quarter, right? They posted some huge numbers. But what's really going on behind the scenes? Well, that's what we're going to break down today. Let's get into it.
All right, first up, the number that's got everyone talking, 21%. That's the year-over-year jump in their adjusted earnings per share. I mean, that's not just good. That's a massive leap. It tells you something is clicking, and clicking in a big way. And if you listen to the CEO, Michel Khalaf, this was no accident. He's pointing straight to their diversified business model and what they call their new frontier strategy. So in his mind, this isn't just a lucky break. It's the plan working exactly as it should. Okay, so before we dig into how they did it, let's just take a quick look at what they did. What does a very good quarter actually look like for a giant like MetLife? So that 21% growth we talked about, well, here's what it looks like in cold hard cash. $1.6 billion in adjusted earnings. And that's just for the quarter. This is the number right here that's driving the whole story.
So, where did all this extra cash come from? I mean, that's the big question, right? And you might be surprised to learn that a huge chunk of it isn't just about selling more insurance. It's about how they're making their money make more money.
Okay, check this out. There's this line in the report called variable investment income. Now, just think of this as the bonus cash they make from their investments, especially from things like private equity. They were hoping to make around $425 million, but thanks to some really strong returns, they actually brought in $483 million. That beat all by itself is a huge reason why the quarter was so strong.
But as big as those investment gains are, they're not the biggest story here, not by a long shot. The real headline grabber, the thing that points to their massive future, is this jaw-dropping $12 billion deal. So, what on earth is it?
It all comes down to something called a pension risk transfer, or PRT. Now that sounds super technical, I know, but the idea is pretty simple. Imagine a big company with thousands of retirees. They basically pay MetLife a giant check, and in return, MetLife takes over the job of paying all those pensions, forever. It's like MetLife becomes the new permanent guardian of that company's retirement promises.
And here's the kicker, the part that really shows you the momentum they have. That $12 billion, that wasn't even in this quarter's results. No, that was all secured in just the first month of the next quarter. It's like they finished a great race and then immediately started the next one at a dead sprint. This engine is just warming up.
All right, so we've got these huge deals in the US. But this isn't just an American success story. MetLife is a global beast. And when you look around the world, you see some of their other businesses are absolutely on fire too. So if you just scan down this list, you can see there's pretty solid growth almost everywhere you look. I mean, Europe, the Middle East, their retirement business, all up. But come on, one of these numbers just leaps off the page, doesn't it? 34%. Let that sink in. That is the year-over-year sales growth they're seeing in Asia. We're not talking about a small, emerging part of their business here. Asia is a powerhouse for them, and right now, it is just exploding. So what's fueling this? Well, you've got Japan, where new retirement products are flying off the shelves. Sales are up 31%. Then you look at places like Korea, China, and India. Together, they're up an incredible 39%. And it's not just Asia. Down in Latin America, they're getting really smart, partnering with the e-commerce giant Mercado Libre. So now you can basically buy insurance right on their platform. It's all about finding new ways to grow. Okay, so we've got money pouring in the front door. That's great. But the truly great companies are also masters at making sure not too much money slips out the back door. In other words, they control their costs. And MetLife is using technology to basically turn itself into a super efficient money machine. And a big part of how they're doing this is with their own in-house AI platform. They call it MetLife MetIQ. And the whole idea is to use AI for everything, from making customer service better to writing code faster, all to boost productivity and just get leaner and meaner.
And look, you don't have to take my word for it. Here's the proof. This chart shows their direct expense ratio. It's just a fancy way of measuring how efficient they are. Their goal was 12.1%. Where did they land this quarter? 11.6%. Now, that might sound like a tiny difference, but for a company this size, that little gap translates into millions and millions of dollars saved. So, you're making more money than ever, and you're spending less to do it. This, my friends, is what they call a high-class problem. What do you do with all that extra cash that's piling up?
Well, option one, you pour it back into the business to make it grow even faster. And they are absolutely doing that. They've already put $3.4 billion to work this year funding new business, and that new business is generating a fantastic 19% return on average.
Then you have option two,
You give it back to the people who own the company, the shareholders. And they're doing a lot of that, too. In this quarter alone, they handed back $875 million through dividends and by buying back their own stock.
And that right there is the classic balancing act. It's the tightrope that every successful company has to walk. On one side, you're fueling future growth by investing in huge opportunities like those pension deals. And on the other, you're rewarding your investors today by returning nearly $1 billion to them every single quarter.
Right now, they are sitting on a mountain of cash, almost $5 billion, which is way more than they even target to have on hand. And that leaves us with the big question for MetLife's future. You've got what could be a once-in-a-generation opportunity to grow with these massive pension deals. So how do you decide? How do you balance going all in on capturing that future growth while also keeping the people who own your stock happy right now? That's the billion-dollar question they're facing.